Germany, once a powerhouse of European industry, now faces a steep economic decline. Rising costs, intense global competition, and structural challenges are crippling the economy. Let's break down the 7 key reasons behind this collapse and what it means for the future. Reason 7, a surge in bankruptcies. In 2024, 22,400 companies filed for insolvency in Germany, a 25% jump from 2023. Small businesses, which form the backbone of the economy, were hit hardest. Over 80% of insolvencies involved firms with fewer than 10 employees. Larger corporations haven't been spared either, with a 44% rise in bankruptcies among companies with over 250 employees. Financial losses have soared. Credit reform reports 56 billion euros in losses in 2024, nearly double the previous year. Lingering effects of COVID-19, high energy costs, and the withdrawal of government aid are fueling this crisis. Many small businesses have reported that rising operating expenses have made it nearly impossible to break even, forcing closures. Larger firms, particularly those in manufacturing and retail, are also feeling the heat, with a combination of falling demand and higher input costs. Experts predict 2025 could see bankruptcy rates rivaling the 2009 recession. This trend poses a serious threat to Germany's economic stability. As Germany drives much of the EU's economy, these struggles risk spreading across the continent, potentially triggering a broader European financial crisis. Reason 6, high labor costs. German manufacturing workers earn over €93,000 annually, far exceeding wages in countries like Poland €33,000 or China €18,000. This makes production in Germany significantly more expensive, prompting businesses to relocate. High taxes and social contributions further deter investment, especially in industries that operate on tight profit margins like textiles and consumer electronics. Mercedes-Benz CEO Ola Källenius has openly criticized declining productivity and rising absenteeism. These issues add to labor costs and make Germany less attractive for businesses. For instance, manufacturers in the automotive and machinery sectors are increasingly moving operations to Eastern Europe and Asia. This shift is not just about lower wages, but also about the flexibility and speed these regions offer for large-scale production. Without reforms, Germany's industrial base risks shrinking further. The ripple effect on dependent industries, such as logistics, supply chain management, and local service providers, could exacerbate unemployment. The erosion of the industrial sector would also weaken Germany's export-driven economy, reducing its influence in global trade. Reason 5, automotive sector challenges. Germany's automotive industry, once a symbol of engineering excellence, is losing ground. Volkswagen's billion-euro failure in vehicle software development highlights its struggle to adapt to the digital age. Software delays and compatibility issues have cost the company significant market share, forcing it to outsource development to China, a move many see as a strategic blunder. Electric vehicles, EVs, pose another issue. The Volkswagen ID.4 has underperformed in key markets like the US, losing out to competitors like Tesla and China's BYD. While German automakers were pioneers in internal combustion engines, they have been slower to embrace EVs. Tesla's advancements in battery technology and BYD's affordable pricing have left German brands playing catch-up. Legacy systems and slow innovation are leaving German automakers behind. Suppliers and service providers, many of which are small to medium-sized businesses, are also facing significant challenges. Reduced orders from major automakers mean layoffs and financial strain across the entire automotive supply chain. Furthermore, Germany's strict regulatory environment is making it harder for startups to fill these gaps, stifling innovation. Reason 4, competition from China. China's rise has reshaped global trade, and Germany is feeling the pressure. Aggressive pricing, often below cost, has eroded Germany's market share in sectors like automotive and electronics. For instance, Chinese EV makers are not only competing on price, but also offering advanced features like superior battery range and integrated software solutions that German automakers struggle to match. To cut expenses, many German firms have outsourced production to China, only to become dependent on a competitor that's more innovative and efficient. China's dominance in renewable energy, semiconductors, and EV batteries further compounds the issue. German firms that once led in solar panel production, for example, have been overtaken by Chinese manufacturers that benefit from massive state subsidies and lower production costs. Germany increasingly imports high-value goods from China while exporting lower-value items. This trade imbalance not only undermines Germany's economic position, but also creates dependency on a single market. The long-term risks of this dependency are significant, particularly as geopolitical tensions between China and Western countries escalate. Energy costs. Germany's transition to renewable energy has led to some of Europe's highest electricity prices. Industrial users pay nearly double what businesses in France or Poland do. These costs have crippled energy-intensive sectors like steel, aluminum, and chemicals, which rely on stable and affordable electricity to remain competitive globally. Meanwhile, China's state-subsidized renewable energy sector produces electricity at far lower costs. German companies are either relocating or shutting down operations, weakening the industrial base. For example, several major chemical plants have moved production to the United States, where energy costs are significantly lower. These relocations not only cost jobs, but also erode Germany's technological edge in these fields. High energy prices also affect consumers, reducing spending power and slowing economic growth. Rising electricity bills have forced households to cut back on discretionary spending, which further impacts sectors like retail and hospitality. Without significant changes to energy policy, Germany's economy could continue to spiral downward. Reason 2. Supply chain vulnerabilities. Germany's reliance on global supply chains has exposed critical weaknesses. Post-COVID shipping disruptions and geopolitical tensions have created bottlenecks. For example, semiconductor shortages have stalled production across industries, from automotive to consumer electronics. China's control over semiconductors and rare earth metals has worsened delays and raised costs for German industries. In 2024, several German manufacturers reported months-long delays for critical components, forcing them to scale back production or miss delivery deadlines. This dependency is especially concerning given the increasing tensions between China and the West. Additionally, trade barriers in key markets like the US threaten Germany's export-driven economy. The US Inflation Reduction Act, which offers incentives for domestically produced goods, has made German products less competitive. Diversifying supply sources and boosting domestic production are urgent priorities, but such changes require time and substantial investment. Reason 1. Economic pressures converge. Germany faces inflation, rising living costs, and higher interest rates, which are squeezing consumer spending. Bureaucratic red tape and excessive taxation are stifling business growth. Many companies cite the difficulty of navigating Germany's complex regulations as a significant barrier to expansion or innovation. The automotive sector's decline amplifies these issues, triggering job losses across related industries like logistics, retail, and hospitality. Every job lost in the automotive industry has a multiplier effect, leading to reduced demand for goods and services in other sectors. In 2024, consumer bankruptcies rose 8.5%, with 72,000 cases filed. This uptick in personal insolvencies reflects the broader economic strain on households. Combined with lagging innovation and global competition, these pressures are pushing Germany to the brink. Public frustration is growing, with protests over high energy prices and declining job security becoming more frequent. The government's ability to address these issues will determine whether Germany can regain its footing. Can Germany rebound? Germany must lower energy and labor costs, boost innovation, and strengthen supply chains to recover. However, the political will to enact such reforms remains uncertain. If changes are implemented too slowly, Germany risks falling further behind its global competitors. Is Germany's economic decline reversible, or are these challenges too significant? Share your thoughts below, and don't forget to hit that like button and subscribe for more insights into the automotive industry.